Perfect. No, hey, let's spread the love.
Okay. Okay. Here we go. Welcome. You're listening to Mortgage Investing 101, the show where we discuss high-yield real estate and mortgage-backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co-host, Mark Hahn, broker and president of Pacific Private Money, one of the fastest-growing private mortgage investment firms in Northern California. Our goal is to provide information and to increase your awareness of these important alternative investment strategies where you can earn, get this, secured high yields using your savings or IRA accounts. Annual yields of 8% and more are not uncommon using these strategies we're going to discuss in today's show. If you like what you hear today, please call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. You can also call our hotline, 888-529-1134, and leave your name and your question, and we'll get back to you after the show. And for fun, we're also going to have trivia contests before each commercial break, where the first three callers with the correct answer win a free 3-day, 2-night vacation. And the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. And the vacations are free. Lighthouse is only requesting a $75 cleaning fee. Check them out at lighthouseforfun.com. Today's trivia theme is off-color nursery rhymes.
Awesome.
Awesome. Okay, and before we get started, I just want to give a little plug here to the Wine Country Inn. We just stayed there. If you've never been there before, and they are in St. Helena, and it's amazing how large the rooms are, and they give you a nice big breakfast in the morning, and in the afternoon they give you an
They treat you like a king.
They treat you really like a king. Check them out at winecountryin.com. Okay, Mark, tell us, why are we here at Mortgage Investing 101?
Well, to help you listeners out there afford to stay at a beautiful luxury resort like the Wine Country Inn, you need to find a way to earn higher yields on your retirement savings. I mean, let's face it, one of the biggest problems that we boomers, and that, Edward, you and I are of that age, where we're, tail end of the baby boomers, we're in our early 50s, and we're looking ahead to retirement. And what have we experienced in the last decade, actually, 12, 13, 14 years, that is low interest rates, low savings rates, low CD rates, low bond rates, and the stock market, unless you were really good at picking individual stocks, if you have just been investing in mutual funds or the stock market indexes, you really haven't seen a significant net return.
Well, if you think about it, the market was 14,000 something back in 2006, 2007.
Yeah, I forgot my graph, but you're right.
Yeah.
I mean,
Okay, and then it dropped like a rock to about 7,000. So you lost 50% of your money, and then it came back. So it's a little better than break even right now, and it's only taken 7 years.
Right.
In that time, you could have been earning a solid rate of return of at least 8%.
Right. If you were participating in what we're going to be talking about today, mortgage investing. So again, just to kind of finish up with the retirement issue that most of us are facing, and a gentleman by the name of Tom Anderson, who's founder of Petsco, which is one of the largest IRA custodians in the country, was quoted as saying that most Americans are not on track to retire successfully. And what's interesting, he said that before the mortgage meltdown, and when everything went to what in a handbasket in 2007, 2008. And so, we were all joking about how our 401k was now 201k, but it's not a joke. It's and so we're still faced with current low interest rates, and for the next several years, I don't know anybody who's predicting a rapid increase in savings rates. Even the Fed, who's been very active in keeping rates low, I think they're going to be pretty proactive if they see something happening that might be indicative of inflation or something else. So I think we've been in this now going into the second decade of low interest rate policies, and there's been a lot of benefits to the economy overall of that, but it's not been a benefit to savers. And so those of you who don't trust the stock market and you're looking at your retirement savings account and going, man, I need to figure out a way to get that yield up. If I want to retire in the lifestyle that I envision, at 1, 2, 3, or even 4% annual yield on that savings, it's just not going to cut it.
Well, and if we were talking 4% interest, you and I wouldn't be here talking about mortgage investing.
Right, exactly.
But as the the opening of the show, we were talking about annual yields of 8% or more are not uncommon.
Not uncommon.
And part of this also is that they're secured. Now, what are they secured by?
Mortgage. When you participate in mortgage investing, you're participating in an investment strategy that is secured by real estate. So let's talk a little bit about what mortgage investing is. First of all, the name mortgage investing includes things names that you may have heard before, like private lending, or trust deed investing, or maybe investing in a mortgage pool fund, in a private mortgage pool fund. And so those are all terms for what we're generally calling mortgage investing. Individual loans or a pool of loans like a mortgage pool fund. And people who have been participating in this type of investment strategy in the last 5 years have consistently seen returns of 8%. Some have even achieved returns of 9 and 10%, depending on the types of loans and their appetite for risk. If your appetite for risk is low, and we tend to, at Pacific Private Lending, we tend to cater to people with a low appetite for risk. So we're talking about well-secured returns, fairly conservative underwriting guidelines, conservative loan-to-value ratios, and yet we're still producing returns of 8% or more month in, month out, year in, year out, and our clients are thrilled.
So this doesn't have to be for the super sophisticated investor. It could be pretty much for the little old ladies who just want a good income.
It's designed to be a simple investment. In fact, here's this is a relatively new show. We've been doing this show. I think this is number 4 in a series of 1-hour shows to discuss the aspects of mortgage investing. And each of the previous shows, we started out in the first segment by kind of talking about like 5 bullet points that I have very quickly, and then we can kind of go back and maybe get into a little bit more of the meat of that. But the first bullet point we've already talked about. It is a solid way to earn 8% or more on your savings. Number 2, it's been called one of the best kept secrets by many financial experts, and we'll talk about that a little bit later. But mortgage investing, number 3, is it's a no fee, no load investment, and that's probably one of the.
That's a big. That's
in addition to the 8% or more,
yeah.
Returns, the fact that it's no fee, no load, no commissions are paid off of your money. At least not that it costs you anything. You put in $100,000, that entire $100,000 goes to work for you. It works for the entire time you're invested, and when you go for redemption, you get $100,000 back. No fees, no load, no commission charges.
Okay, so far, so good. So I know there's got to be some risk, which we'll get into later.
And then number 4, mortgage investing is backed by real collateral, like we just said. It's real collateral. It's real estate, and it's not 100% financing. It's typically 50, 60, maybe 70% loan to value. You're talking significant protective equity behind that. And then last but not least, number 5, it's in my opinion, it's easy to understand this type of investment. It's easy to make the investment. We make it very, very simple to invest in
and
mortgage
it's short term. We're not talking about like when when Wells Fargo makes me a loan on my house for 30 years. That's great for me having a 30-year loan, but you're not making 30-year loans.
No, and we'll talk about the types of loans that are the security for your investment. And I want to make one more point on point number 5 about being easy to invest and easy to understand, is that your financial planner is never going to recommend this to you. And the reason for that is because we call it a no load, no commission. We are in the business of making loans, and we make loans to borrowers, and those borrowers pay our fees, but those fees do not get deducted from you, from your investment. They're at no cost to you. So we have a business model that allows us to make a profit from generating these loans using your money, but a financial planner does not. And so for them to say, well, Mr. and Mrs. Smith, you should diversify your portfolio with maybe some trustee investments or some mortgage pool funds, and
take assets out of
unless they like working for free, right?
Exactly.
They're not going to make any profit from that. They're not allowed to accept commissions or referral fees from me, and I'm not allowed to pay them, and I don't. So there's a little bit of a challenge here, because oftentimes I talk to people see our ads or hear about us or refer to us and call me on the phone and say, well, I'm going to go talk to my financial planner. They call me back and they say, well, my financial said this, and my financial planner said that, and and they'll basically poo-poo all over the deal because realistically they A, they don't understand it, and B, they can't make any money off it.
But interestingly enough, you've had, and a lot of times when you talk to attorneys, they're the first ones who will no. But interestingly enough, because they have no reason to say yes, interestingly enough, you have a very well-known local attorney who he's a real estate attorney.
Yep.
And he specializes in real estate, so he knows this stuff inside and out. And how much did he invest with you?
Well, he's invested actually over $1 million during the course of his investment. He recently invested a significant amount in our mortgage pool fund, but he's also done individual investments. He and his wife, and not just attorneys, and including this noteworthy real estate attorney, but I have financial planners who are clients who invest their own money with us.
Interesting.
But they don't refer their clients to me. So
that's interesting.
So talk about that's why I say it's one of the best kept secrets.
Maybe their attitude is, we're testing the waters right now.
Let me investigate this for you. If in
For the next 5
years
years
I've made an 8% annualized return and doubled my money in that in that time period, then maybe I'll refer you to this guy. So anyway, mortgage investing, we're obviously we're very bullish on it because we think more people should be aware of this, what's considered an alternative investment strategy, but it's no more alternative than investing in real estate. It just means that you can't buy this investment through your current your current financial planning account. If you're with Merrill Lynch or Schwab or Fidelity or with one of the big houses,
or even the real estate,
or with your bank,
or the real estate salesperson who sold you your house, they're not going to be investing in us. Tell you what. We are going to cut to our first commercial break because when we come back, we want Mark to talk about the deal of the week because he just got back from looking at a deal. He's going to explain what specific deal he's looking at, and then the audience, you can understand what we're talking about a little bit more. Okay, here is the first trivia question, and again, the theme is off-color nursery rhymes. Which nursery rhyme is most likely related to King Richard III as he fell from his horse named Wall? First 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. Which nursery rhyme is most likely related to King Richard III as he fell from his horse named Wall? 888-529-1134. Make sure to include your name, your email address, speak slowly, spell out your email one letter at a time. Don't touch that dial because Mortgage Investing 101 will be right back.
Awesome. Good. How long was that segment?
13:06.
Oh, okay.
Yeah.
Perfect.
I figured if we cut to a break sooner rather than later, then I think we'll keep them thinking we'll keep it a little bit rather than just going 15-15.
Absolutely.
You know what I mean?
Yeah, that's fine.
Especially since it's like teasing them with, hey, we're going to come back with the deal of the week.
Nope, that was good. You're a good host. You know what you're doing.
Oh no, you're good. You had some great stuff. I mean, I'm listening as I'm the audience listening in too, and I thought that was very good. I figured it makes it easier for me to just use the questions from the BOI. So,
well, how much work can you? I mean, there's only so much time you got. It's not the only thing you do. These 3 shows. Now, are you doing it on the 3rd show too? On the
yeah, but those are sports questions.
Oh, okay.
Yeah, and it's kind of fun. That's fun because I get to try to stump the 2 guys. And I usually do because I come up with kind of hard ones.
I listen to CanVR in the mornings when I'm showering, listening to Murph and Mac. And
yeah,
it's just it's so sad because it's like everyone's just so upset about how the Giants have just gone from the first third of the year they were at the top, and now when it matters they're they're talking about we could potentially see them lose 100 games this year, which would be as bad as you can get.
Well, I've got the Giants. I don't know if I told you this. I've got the chief information officer coming on. He's the guy who put the Wi-Fi in. He's got it really high up there. And I said, when can you come on? And then basically what it came down to is, well, we're not going to get to the playoffs, so I can come on in September.
Oops.
Yeah.
Yeah, right. They're not yet.
If you ever get a chance, because they podcast it, they don't. It's funny. Sports Byline
Mhm.
only has like maybe a handful of podcasts, and ours is one of them. Take a
Nice.
listen to the
Okay.
show. It's actually pretty good. I actually had David Vogelstein on. That was a pretty good one last week. Okay.
Good.
Okay, we'll come right in with deal of the week. Oh, question and then deal of the week.
Yep.
Okay. Away we go. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hoff, president and broker of Pacific Private Money, one of California's fastest growing private money lenders in Northern California. And when we cut to the first commercial break, we asked this trivia question: which nursery rhyme is most likely related to King Richard III as he fell from his horse named Wall?
Would that be Humpty Dumpty who sat on a wall?
That is Humpty Dumpty who sat on a
Had
wall.
a great fall.
Exactly. Apparently,
Interesting.
he was hunchbacked and he was hacked to pieces during
What?
the Battle of Bosworth Field, and that's why they couldn't. All the king's horses and all the king's men couldn't put him back together again.
And they made a
Nursery rhyme. Yeah, that's what I want to sing to my kids when they're
word.
young.
Yeah.
Okay. We are talking, the name of the show is called Mortgage Investing 101, and we're educating the public on trust deed investing. And the first segment, we got into basically what it is. Mark, let's just get right into it. Deal of the week. What are you working on specifically that we can explain to the audience?
So we'll talk about a deal of the week, and the reason why we're going to talk about that is because we talked in the first segment about how mortgage investing is a way to make 8% or more on your money through what's been known called trust deed investing, or even more, mortgage pool fund investing, trust deeds or mortgage pool funds. Two different ways that you can participate in mortgage investing and earn 8% or more on your money. So we're talking about how it is you make that 8%. It's because we are in the business of originating real estate secured loans. And it's the type of loans we make that make the rates and returns that we pay possible. So we all know what happened in 2008. We had the subprime meltdown, we had the whole mortgage meltdown, and banks went from loaning money to anyone who could fog a mirror to now making it very, very difficult to borrow money. You have to actually prove your income and have a real job and have real money in the bank.
No more stated income.
Yeah, no stated income. Yeah, you got to be able to prove all this stuff. And so, but more importantly, by and large, they stopped making a certain type of loan. The banks since 2008 have focused on making consumer home loans, and they have made gobs of money in the last 5 years just making consumer home loans.
Meaning just for personal
For
residence.
personal,
Okay.
you want to buy a primary residence, you go to the bank, you get your loan. But what about all those real estate investors out there that are either building homes or buying homes and remodeling them, buying, fixing, and flipping, which has been an important component to the real estate recovery as we remodel and rehabilitate homes that are in need that you couldn't even buy with bank financing, or commercial properties, or if you own rental property and you want to pull cash out, or maybe you want to buy and hold income property.
If you have a loan already that's coming due.
Yeah, that's right.
What do
You
you
need
do?
to refinance an existing loan. So banks generally stopped making loans to real estate investors, and that's who Pacific Private Money and other companies like ours who use private capital for their mortgage-backed investments. That's who we lend to. We're making loans, mostly short-term loans, to real estate investors. People who, for example, buy fix and flip, they want the money for a short period of time, usually no more than 6 months. Or if it's on rental property, it might be 24 months. But usually the exit strategy, meaning how are they going to repay the loan? They're either going to improve and sell the property, or their credit score is recovering from maybe something that happened to them. A lot of our borrower clients have a foreclosure, and then after a few years that goes away, and now they're bank financeable again. So there's a lot of reasons why we make loans to certain clients.
Or there could be loans to in real estate investors where the property really wasn't very good when they first entered it, but they remodeled it.
It's in bad
Now
shape.
there's bad shape, yeah. And now they're going to just get a tenant, and the income from there will help them qualify for a new loan. So there's different ways for them to refinance out.
Right, so we're talking about mortgage investing where you can earn 8% or more on your money, secured by real estate, and these are real estate loans made to real estate investors. So, deal of the week, as we talked about a little bit earlier. So, yesterday, I drove up to El Dorado Hills to look at a 5,500 square foot property built in the last 10 years, and it's a short sale. And the buyer, who happened to be also a real estate professional, was buying this property. Was getting it for a very good price. It happened to be $730,000. We had an appraisal on the property saying the property was worth $900,000. Now, whether or not it's truly worth $900,000, maybe they'll be able to turn around and do some minor modifications and sell for $900,000.
No deferred maintenance?
No, gosh, no.
Okay.
Well, the people who moved out took a few things with them, but they didn't take the pipes and the
Yeah.
kitchen and everything. I mean, there was some, it needs paint and carpet basically,
typical.
and the landscape is a little bit on the dead side after a hot summer of not being
Sure.
water.
How large is the lot?
1 acre lot,
Flat?
5,500 square foot, 5 bedrooms, 5 baths, on a kind of a little bit of a hill, just literally right next to
A gentle slope.
Lake Folsom. So yeah, gentle
Okay.
slope, lots of beautiful oak trees, and so anyway, they're buying this home for $730,000. They have appraisal that says it is or will be worth $900,000.
Okay.
We agreed to make them a 70% loan, but it's 70% of the purchase price, not of what the appraisal says.
So is that 500,000?
$500,000. It's actually 511 is the exact amount. So if you do the math, 70% of 730 is 511.
That's only that's less than $100 a square foot.
Absolutely, and more importantly, that means they're coming in with a difference.
Yep.
They're coming in with over $200,000 of their own cash, or maybe they've got an investor who's participating in this deal. Again, we generally don't get fixated on where the money's coming from. Again, we're not a bank. We're not going to make them prove that. I want to see I want to see that money seasoned and it's coming out of your account.
Yeah.
Blah blah blah. Again, it's cash, and
Cash.
it's somebody
Cash.
else's
Yeah.
who's putting that money at risk. That's the risk capital, really, is that $225,000 that they'll need to come to the closing table with.
What's the buyer's game plan? Is he just going to paint carpet and then resell it?
So they have a budget for $50,000, which is part landscaping, part interior and exterior repaint and recarpet.
Which they are coming up with.
They're gonna put that in on top of that, and so this is a real estate professional. They've apparently bought 30 homes this year, according to the spreadsheet they sent me, which we verified. Randomly a handful of those, and so we vetted the borrower. They've got a great reputation, and so they're going to buy this property, and they intend to flip it in the next 90 days. Okay, so we're going to make them a loan of $511,000. The note rate is 10%, and so the mortgage pool fund that we're making this loan from is going to benefit from that 10% yield. Now, it is a 90-day loan, which is relatively short term. So for those of you listening out there who might be familiar with so-called trust deed investing, where you would fund an individual note, a 90-day note is not going to be that compelling to you.
Yeah, but let me ask you, did you actually write the note for 90 days?
No, it's going to be a 6-month term.
Okay.
Not a 90-day minimum interest.
Okay, so the anticipation is that within 90 days he's going to sell the property.
Well, they hope. I mean,
but
borrowers always have high hopes, right?
Exactly.
So if something
this
goes
may
wrong,
actually go 4 or 5 months.
It could be,
Okay.
exactly. And
at least you have a guaranteed minimum 3 months. So if for some reason he double escrows this thing, or he just whatever reason finds a buyer in 30 days, you guys are still going to earn 90 days worth of interest.
right, exactly. So we're funding this out of our mortgage pool fund, and so a deal like this is fairly typical. We're doing a volume out of our office of about 20 loans per month, approximately. And so in any given week, we're doing approximately 4 to 5 fundings. And the demand for capital right now is for fairly short term. I mean, there's a vibrant buy, remodel, and flip, or buy, fix, and flip industry right now in the Bay Area. And those guys, they don't want stiff prepayment penalties. They, in fact, some of them want, to be able to guarantee no interest.
Sure,
But
of
we're
course.
usually able to extract at least a minimum. And we try to get 6 months when we can, 5 months, 4 months. But on a
that's
quick
good.
flipper with a reputation for being able to do his job well, we'll give him 90 days. We'll do 90 days. But then again, this is going to be a repeat borrower. So he'll
Good,
pay off this
okay.
loan. We'll make him another loan. He'll pay it off. We'll make him another
Sure.
loan. So the fund is going to benefit from.
Of course, each deal stands on its own. He
It
has
does.
to prove.
Oh, yeah, of course.
Of course.
But that's
But-
a typical
typical
deal
one,
is
okay.
a short-term use of the money to buy, fix, and flip. And for that, they'll pay points, which are origination fees, and a point is 1% of the loan amount. So in this particular case, the lender is paying 3 points for the loan and a 10% note rate. So if he pays it back in 90 days, even though we only got 3 months of interest at 10%, we got those 3 points, and half of that goes to the fund.
Wow,
And the other
okay.
half goes to the sales agents who work
Okay.
on the loan, but in our company. But
That's fantastic.
so 50% of the origination fees on all loans that the fund does go into the fund, so that helps boost the yield. And
Sure.
so we actually like a certain portion of our note portfolio to be quick turn money because it boosts the yield.
Absolutely, if you're getting those points. Now, okay, I'm
Yeah.
thinking, I'm the audience right now, I'm
Okay.
listening to this. First question, with only a 70% of purchase price and roughly 60%, a little less than 60% loan to
Loan to
value.
appraisal.
Loan
if
to
you
appraisal,
believe the
call it
appraised
that,
value.
okay.
Yeah.
First question is, why couldn't he get a regular loan from a regular bank at much less than 10% interest?
Well, first off, this guy called me last week and asked me if I could close by the following Friday. That's 5 business days. No bank on the planet
Yeah, that's
is
true.
going to close in 5
And
business
then that
days.
was part of the deal why he's getting such a good deal is he had to close quickly.
Yeah,
It's
it was
short
a
sale.
no contingency, short sale, quick close. That's how they got the deal. Apparently, I
from
met
a real bank.
the
that's a
listing
seller.
agent at the property, and he said he had 2 backup offers at $790.
Oh wow.
So this guy has to close at 7:30, and in fact, we're closing this next week. So we went and looked at the property yesterday. We got we basically approved the loan. We drew up loan docs, sent them to the title company. He's going to sign them on Monday. We'll fund Tuesday, close Wednesday. So it'll be a 5 business day transaction all told.
Okay, so again, I'm the audience
Mhm.
listening in right now. We're not trying to solicit any money, but if people are interested in getting a hold of Pacific Private Money for deals like this, i.e., if they get into in fact, if somebody were to call you and get into the fund, they'd actually participate in this loan, wouldn't they?
Yes, because
Effectively.
an investment in our fund is diversified into all of the assets of the fund. You become a shareholder of the fund, and the fund only owns real estate secured notes at 70% loan to value or below.
You're not buying boats and cars and other things.
No, and we're not fixing flipping our own real estate. We're
Okay.
not buying real estate. We're not doing 100% financing. We're not doing any crazy stuff. We're doing the types of loans we've been doing for the past 5 years. Nearly 550 loans that we've originated to date in this new lending environment, in this new real estate environment.
And this loan is fairly typical of
Yes.
the type of loan.
It's
So
very typical.
So the interest rate, I mean, if I'm going to invest in this fund, I would be a shareholder in the fund that has multiple loans, so I get some diversification,
Mhm.
and one loan pays off, another investment gets done, so my yield will stay pretty consistent.
Well,
It
that-
should say. Okay, so before
that
we
is the
catch
goal.
another break,
Mhm.
really quickly, how do people get a hold of you again?
So again, my name is Mark Hanf. I am the president and broker of a company we call Pacific Private Money, and we're really easy to find on the web. I've always made transparency and is really important for us. And what I mean by that is if you Google my name, the first 8 of the 10 on Google are going to be my LinkedIn profile and all the other places you can find me. But PacificPrivateMoney.com is the best place to find us. We have a Bay Area phone number of 415-883-2150. Again, 415-883-2150. I won't be in my office this weekend, but a typical Monday I'll come back and I've got a number of phone messages our radio audience, which I
Or the
appreciate.
email of
or the emails too, right? So
Mark at
so
Pacific
again,
Private Money.
so check us out at pacificprivatemoney.com, and then from there you can check me out on LinkedIn, Facebook, Twitter. We're all over the place. We're ubiquitous, as they say.
Okay.
We're everywhere.
Just before we cut to our second commercial break, just want to give a little plug here to the beautiful Glen Ellen Inn, which is a trip to the beautiful wine country. It is all about enjoying delicious garden foods and drinking amazing small production wines, most of all relaxing with the one you love. It's the perfect spot for all three. The Glen Ellen Inn, located in the heart of Sonoma Valley. They are actually calling themselves now the Glen Ellen Inn Oyster Grill and Martini Bar.
Are you kidding? Oh, that sounds great.
It's great, yeah.
I wish I liked martinis, though.
I know, I'm not a big martini drinker. However,
if you are, though, it sounds pretty compelling.
Plus, they have over 600 boutique, hard-to-find wines. And I've eaten there before. The food is fantastic. Okay. Also, they have secret cottages, which are just steps away, so stay the night and enjoy your own private fireplace, jacuzzi tub, and oversized shower for a truly romantic getaway. Check them out at glenellenin.com.
I'm there.
Okay, here's this second commercial break. Trivia question. Again, the theme is nursery rhymes, off color, of course. Which nursery rhyme came from the bubonic plague of London in 1665? The first three callers with the correct answer win a free 3-day tuna. Isn't that great? A beautiful nursery rhyme on the bubonic plague of 1665. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. Which nursery rhyme came from the bubonic plague in 1665? One more time, 888-529-1134. Make sure to include your name, your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial, because Mortgage Investing 101 will be right back with some more interesting information about trust deed investing.
Young people are just smarter.
Yeah, don't you love that?
Zuckerberg is brilliant, and for him to make a quote like that, I wonder if he was misquoted, because
That's a good point.
That just doesn't sound like something he would say, because he's not a doofus.
I know, I thought that was a little strange to say that.
But he does make a point. Most people have simpler lives. They may not own a car. They may not have a family. Simplicity in life allows you to focus on what's important. That's absolutely true.
Yes, but the thing is, what's absolutely important is not to have a family. I mean, you got to make sure you don't put those two together.
Yeah. 30 is the new 40. 40 is the new jobless. This guy, Andrew Ross, looks like he's in his 70s.
Yeah.
It's like, fuck you, young punks. Or probably gets paid not a whole
Remember,
lot.
we are recording. I was trying to watch my P's and Q's. Okay. All right.
Okay.
We want to get into in the third and final segment.
Let's see,
which
what have we not,
get this here.
not got drilled down into? So let's talk about the risks
Okay.
of trustee and mortgage pool investing. And when you went off the air, you talked about you used the term trustee. Let's see if we can. I know it's hard to do three shows. Let's it's called mortgage investing. Sorry, because it's more generic. Mortgage
People
investing.
hopefully won't remember that. Okay.
I know. But
Here we go.
Only I hear it.
Yes, that's true. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hanf, president of Pacific Private Money, California's fastest growing private lender. And when we cut to the second commercial break, we asked this trivia question: what nursery rhyme came from the bubonic plague of London in 1665?
Okay, I think I've heard this one before. Is it Ring Around the Rosie?
It is Ring Around the Rosie, and apparently the ring around the rosy red rashes in the shape of a ring on people's faces. They had the pocket full of posies because they thought that the bad smells caused the disease, and also it helped get rid of the nasty smell. And the ashes were because of the cremation of the bodies.
Oh, no.
Yes, all fall down with the plague, where people were sealed up in their homes waiting for death. Yeah, that's a fun way. And interestingly enough, the Great Fire of London in 1666 helped get rid of the rats that caused the plague. So whenever there's a plague, just light a fire. Okay, we have been talking about mortgage investing because the name of the show is Mortgage Investing 101. Now, you told us about this specifically awesome deal in El Dorado Hills
Mhm.
where this gentleman is purchasing a short sale, which basically means the lender is taking a loss.
Yes, there were two loans, the first and the second on the property.
Oh, interesting. Okay, they're willing to walk away for some obviously.
Some portion.
How much was the total loans? Do you know?
I don't, but it's,
Okay.
I know it's over $1 million. They're buying the
Wow.
home for $730,000. So
Okay.
the person who's taking the bank that's taking the biggest loss is the bank that's in second position.
Sure.
We're getting pennies on the dollar, basically.
Okay, so the buyer, which is your borrower, is coming in with probably a little over $250,000 because
In cash to close.
to
Yep.
close the deal, and also he's putting $50,000 into do landscaping, paint and
To
carpet.
improve the property with the goal to resell it eventually.
Okay, so again, I'm the audience. I'm listening in on this conversation that Mark Hunt and Edward Brown are having, and I'm looking. I'm saying that sounds like a pretty good deal. The interest rate that the borrower is paying is 10%. What's the risk?
Right. What's the catch?
What's the catch?
What's the catch and where's the risk? Well, and this is what's so amazing about mortgage investing, in my opinion, and it's one of the reasons why I have such a substantial number of individual clients, many of whom are incredibly loyal, and actually are not thrilled that I'm even promoting it on the radio like this, because the fact that it's one of the best kept investment secrets has been profitable for those who've been doing this for years. And there are actually people who've been private lending for decades and have and just don't even think twice about making 8, 9, 10% return on their money. They're spoiled. They're accustomed to it. And so, but now we're here doing this show to introduce mortgage investing to the vast Bay Area majority and give you the ideas and opportunities that you need to make an informed decision. So risks. Let's talk about the risks. So we're making real estate loans secured by Bay Area property. We're making loans. First off, I want to tell you that the loans we make are virtually identical to the loans that the banks make. In other words, if you go to Bank of America or Wells Fargo and you get a loan, you get a stack of loan documents that you have to sign. We use very similar legal documents. These are industry standard note, promissory note, deed of trust, and there's a number of other supporting documents, which is the rest of the paperwork that have to be signed. There's disclosures to the borrower, there's disclosures to the private lenders, there are good faith estimates, there's all of the same, we use all the same loan documents. In fact, we're a regulated industry. We're required by the Department of Real Estate to use the same, to use certain documents, and it's the same documents that the banks have to make. So we're number one, we're regulated. Number two, we use the same form of promissory note and deed of trust legal documents to secure that loan that we're making to this real estate investor and securing it by the real estate. Number three, all of our loans go through a national title company.
Okay.
We don't do this in-house. We don't use or handle investor capital internally. All the money goes through.
People don't write the check to the Mark Hunt PGI Island Fund.
No. When we fund a loan, the money is wired directly to the title company after the borrower has signed all of the loan documents. We've reviewed all of those executed loan documents, and the escrow and title company are prepared to issue a lender's title policy, ensuring the first position lien.
Okay, that makes sense.
And they've also got the evidence of hazard insurance that names the lender as in their mortgagee clause as an additional insured.
Okay, so from a risk standpoint, let's say you've answered all the questions regarding like potential fraud or something like that, just in case the guy doesn't really, he's not in contract or something like that. I mean, you've done all your due diligence to make sure, because the title company is going to make sure that that you really are going to be in first position on that specific piece of property. Okay, so that's off the table now. We don't have to worry about fraud. What other risks? I mean, because I'm listening to this and going, okay, the property theoretically is worth over $900,000. The purchase price is $730,000.
Right. The loan is $511,000, which is 70% of the purchase price. So what are the risks? Well, just, and again, because I think it's worth driving this home, all loans are funded through a title company. All loans are provided with a lender's policy of title insurance, and we always insist on an ALTA policy, which we may get into the details of that in a future show. We always require hazard insurance, naming the lender as an additional insured. So there's two types of insurance on every deal. There's the hazard insurance in case the property burns down, so the lender gets paid, not the borrower. And then there's the insurance by the title company saying, yes, you are in fact getting a first position lien on this property. And so, so the risks then really become, what if the borrower doesn't pay, doesn't make the monthly interest payments? And again, our loans are made generally with interest-only payments by the borrower. If he borrows $500,000, he's going to make interest-only payments, and at the end of the term, he's going to pay back $500,000.
Yeah, because I mean, what you're looking at is either the borrower pays or the borrower doesn't pay.
Right.
So if the borrower pays, you're going to get 10% on your money.
Right.
If the borrower doesn't pay, then what?
So if the borrower doesn't pay, then we would, and let me just say, out of the 550 plus loans we have originated since 2008, less than 2% have gotten into trouble. Less than 2% of those loans have, quote, gone into default, and less than 1% have actually been foreclosed upon, and none of those resulted in a loss to the lender.
So again, I'm trying to be the audience listening in and hearing 2% and 1%. What was the difference between those two?
So just because you file a notice of default, which is called, when you foreclose on a property, it's a process. It's a 4-month process that starts with the filing of a public notice called the notice of default. That starts the clock ticking to the point where the property would, 4 months later, go to auction. Now, most foreclosure processes do not result in a property going into auction. More often.
Why is that?
Well, because the borrower figures out a way to reinstate the loan, to bring the loan current, or to sell the property in time before the property actually goes to
Otherwise,
auction.
they're going to lose it completely.
Yeah.
Okay.
Or he just needs a little bit more time to finish the property, put on the market, and sell it. In which case, we delay foreclosure. So very, very few properties actually end up, at least very few properties that we've been involved with since 2008, post real estate crash, very few properties have actually gone foreclosure. The ones that have done, the lenders are thrilled on the property. And again, we're talking about like 5 properties out of 550. So
well, I would think, okay, now if you are the lender and the borrower doesn't pay for, let's say, you said it's a 4-month process. So he doesn't pay, let's say, for 2.5 months, and suddenly he pays. There's got to be some kind of penalty.
Well, there is, and that's the good news, is because it's actually not necessarily bad news for you, Mr. Lender, if you make a loan. Let's just, in this case, we're talking about, what if I made an individual loan? What if I did what's called a trust deed investment, where I'm the lender on an individual loan that's brokered by a licensed real estate broker like Pacific Private Money. And it's a $200,000 loan, and I fund that $200,000. He makes the first couple of payments, then doesn't pay. And so what happens? Well, we build into our promissory note a 10% late charge after 10 days, first of all, number one. So you're automatically entitled to receive a 10% late fee.
So if the payments were supposed to be $1,000 a month,
there'd be a $100
extra
fee.
penalty. Okay.
Number 2, we have a default rate that we can exercise in the note, and our practice is to make the default rate 4 percentage points higher than the note rate. So if the note rate's 10%, the default rate's 14%. So we have the right to increase the interest rate on this note that's now in default.
That's quite an incentive for the borrower to make sure he makes his payments.
Well, look, it's not like we're being predatory. This is a contract. The guy came to us, asked to borrow the money to execute a business strategy.
Yeah, it's
real
not
estate investing is a
house.
business strategy, right? And so we're saying, well, we're willing to make you this loan, but look, we're not going to mess around here. There's late fees after 10. We're not going to give you a 15-day grace period. It's 10, and the late penalty is not going to be 3 or 5%. It's 10%, and we have a default rate. We're going to bump that rate up 4 percentage points if you don't pay. So really, I've done deals where the borrower ran into trouble, couldn't make the payments. We executed the default rate by raising the rate and charging the late fees. And when he finally sold the property, and the title company comes to us and say, "Okay, Mr. Lender, I need a payoff statement from you." We made sure that we got all the unpaid interest, all the late fees, and the default rate of interest. And so I did a loan a couple of years back where over a 6-month period on a 10% loan, my lender actually got an effective return over that 6-month period of 16% on an annualized basis.
That's amazing. So that actually, the bad news was actually good news.
The bad news was good news. So the really, so the risk, getting back, let's come full circle, talking about mortgage investing and how to make 8% or more on your money, and sounds too good to be true. There must be risk. Well, there is a risk. I mean, in real estate, there's a risk. Look what happened in 2006, 7, and 8.
Sure.
I mean, we know real estate does go down, but most of the smart money, at least right now, believes we are in a recovery, that real estate prices have stabilized. And so, but we're still not making 80, 90, 100% loans. We're making 50, 60, 70% loans, so that if the market does suffer another correction in the near term, and we see prices go down 5, 10, 20%, we still have enough protective equity in that property to where there's not a risk of loss of principal.
Well, also the borrowers in this case, like the El Dorado one you're talking about, I mean, he's got $250,000 skin in the game. I mean, he's not going to just walk away from that.
Right, and his plan is to sell the property. So the great thing about the real estate market is it doesn't move that quickly. It doesn't move up that quickly. It doesn't move down that quickly. Although it may feel like, wow, in the last year, real estate prices are up 20% in some markets. Like, well, that feels like it's quickly, but on a month-to-month basis, you usually get rid of real estate. You may not make as much profit as the borrower. As a borrower, you may not make as much profit as you plan, but this guy really can't, or we can't lose as a lender as I see it. When I say can't, I mean that the risk is so small as to be negligible.
Okay, so let's go even one step further. So this borrower pays for a month or two and suddenly runs into problems, stops paying, and it goes the full length of the foreclosure.
We file foreclosure, meaning, we as Pacific Private Money, we have professionals, services that we engage. The guy misses his payment, he goes 30. If he gets to 60, we generally file a notice of default. We start the foreclosure process. We're not going to wait 6 months like a bank might.
Yeah.
We're not going to talk about modifications. There's no modifications in private money. I'm sorry. We're not going to lower the rate. We're not going to do this. We're not going to do that. We're going to file a notice of default. We're going to start the foreclosure process. 4 months later, it goes to auction. Our lender gets paid back. So if in the case of the fund, of course, the fund is actually going to end up benefiting, assuming that we get all of the interest rate that was due and the late fees and penalties.
Okay, but let's say that, so now let's say the borrower still can't come up with the money. Now, we've all heard about, going to the courthouse steps.
Yeah.
Now, I guess in theory, some new buyer is out there on the courthouse steps, and he could pay it all off, or he doesn't have to be the borrower. You don't care where the money comes from.
Well, and that oftentimes happens. So in that case where, we foreclosed one time, a borrower got sick and just refused to contact us. We found out later he was sick, and
at first it looked like he was just avoiding.
He went off the grid basically, and we started the foreclosure process, and we were literally 2 weeks away from the auction. But this loan was made at 50% loan to value, so we knew, the lender was like excited, thinking he was going to end up owning this 4-unit rental property in Vallejo, and turns out that I told him there's no way, Tom, that you're going to own this property because a real estate investor is going to buy it. The price is just too. Even at the price you're going to, even with all the late fees and penalties and default interest and all that, someone's going to buy it at the steps. Well, as it turns out, the borrower resurfaced and got caught up, and it was a happy ending for him. And our borrower still got, the late fees and the higher interest during that period.
He just didn't get a super bonus
right.
of owning the property.
He didn't end up owning the property. Exactly.
Okay, so again, we are talking about mortgage investing. The name of the show is Mortgage Investing 101. And if you're interested in any kind of mortgage investing, Mark's got a fund. I guess that's one of the good things about the fund is that if a borrower misses a payment, there's enough loans in the portfolio that are still paying that checks will still be coming to the investor.
Absolutely. We make quarterly distributions of interest and profits from the fund, and late payments or non-payments, because there's so many loans in the fund, it's well diversified, that's generally not an issue. It has negligible impact on the fund. But we also do just, again, just to be clear, we do both individual notes and mortgage pool investing. So clients of Pacific Private Money can participate in trustee investing as well as mortgage pool funds. If you want more information, please contact us at 415-883-2150. Again, that's 415-883-2150, or find us on the web at pacificprivatemoney.com.
Excellent. And we got to cut out for today. This was a pretty fast show.
Fast hour.
But again, for people who are interested in investing in Mark, he's got his Pacific Private Money Fund, which is still earning 8% interest. 415-883-2150. Just call him and find out more information about it. Okay, tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks for listening. I'm your host, Edward Brown, and on behalf of Mortgage Investing 101, so long. We'll catch you next week.